So we had the largest single day intraday rally in the VIX and the largest decline single day in the VIX, both in the same day.
Yep.
Which is just beautiful that this sort of thing can happen. So this is the VIX August 5th. And then we compare that, let's say, to this is the COVID, but this happened over a period of
Multiple days.
Exactly. I think it was like 2 weeks almost.
I was at my desk the whole time it happened. Yep, I remember.
And we've had other volatility spikes, but again, none of them were single days. So we had the VOLMAGEDDON over here. We had the Chinese yuan deval, 2011.
There was the flash crash in 2012.
Right.
Yep.
And then this is all reverberations from what we had from the global financial crisis over here. But I mean, we've not seen anything like this. I mean, from the lows of volatility, which is it's always from the lows. It's always from the lows of volatility. You never see it like climb bullishly and then spike up. It spikes up.
Yeah, it's interesting. I love this chart here, by the way, because this is, again, I think something that we should constantly be considering, especially when building strategies over the long run. There are always these really slow tapering down periods of volatility, followed by huge spikes in volatility. Every instance you can see here where volatility gets down into the 10s or 12s is followed by some kind of an event. And honestly, this scenario I'm describing, I think, plays a role where people start to develop strategies or they start to trade in markets in these really tight volatility zones where ATR is low, generally low. Intraday activity is fairly manageable. There's not huge drawdowns within the beginning of a day. It's easier to trade those periods of time because price doesn't chop around as much. And then all of a sudden, there's more and more and more market participants that are trading this tight zone, and they're all feeling really confident. Everybody feels like a genius because everybody's making money in a bull market. And then there's a volatility spike, and guess who gets trapped? Everybody who's trading in these really, really tight zones. I can't say that I predicted at all where this volatility zone was coming from, but I'm telling you, for weeks now, I've been looking at a VIX of 12 and going, we're going to see something. Something's going to be a catalyst.
So what happens is with these, which is so fascinating, what happens when you have these periods like you were just describing where the volatility is ebbing lower and lower and lower. And so what happens is that once you have a trend, then you have the people who come in to take advantage of that trend. So what are people doing in those low volatility regimes? They're selling vol. They're selling vol. They're collecting the premium on that because they're going, well, it's been going down for the last year and a half. And if I sell it, I know I'm going to have this guaranteed return of these premiums. But then it gets to the point where it's essentially maximum complacency, where there has not been, it's so strange how people think, there has not been a volatility event in so long. They go, well, tomorrow should be fine.
It should be good.
And it's exactly. Yeah. Then this window of happens, a catalyst occurs, and then you have where everyone's on the wrong side of the boat. In fact, it's not unusual. If I'm not mistaken, I think a bunch of these volatility spikes in the VIX happen in August. Because it's exactly the period of time where people are away on vacation. They're not really paying attention. They have these automated systems set up, and then boom, something can happen, and then it could cause a catalyst. I think even Bear Stearns collapsed in August, if I'm not mistaken, before the GFC.
Could be. Yeah, it's a good observation.
And so you get these spikes, and so but what's fascinating to me is that so we've been talking about zero dated options, and which causes it causes gamma to go crazy when the volatility spikes happens intraday. So you can imagine over a period of days like we had with COVID, where volatility as a measure of uncertainty, we're like, we don't know what's going to happen, and so volatility, like, it spikes and then it rises, and then you have this volatility regime for a period of time. But here, with the zero dated options, what happens is that once they get into the money, those options, because they're zero DTE, the gamma on them are so high, which means that as they get into the money, they go into the money drastically, way higher, like a lot faster. And that causes the market makers to have to sell the stock, to sell the futures in order to keep their books balanced. So it drives down the price. The increased value of the puts drives down the price. But then because there's zero DTE, they close out at 3 o'clock. Or you can't get any more after that point. And so then the puts get monetized. And what happens? Well, then the market makers have to buy back the the positions at the hedge positions. So then we have this spike up, and we're going to see so much more of this happening again and again and again and again because of how cheap short dated options are, how mispriced volatility it becomes, and how big of a magnitude of these moves can actually occur. So I'm expecting this to be this type of thing not to go down in history August 5th as oh my god, remember the vol spike? I'm expecting 10 more of these over the next 2 years at even higher amounts. And what we saw in the Nikkei, the drop of 25%, we're going to see that in the bond market. We're going to see that in the stock market. We're going to see that in all kinds of different places where we're going to have these massive volatility events. This is what I'm expecting, and I felt very vindicated with this.
Don't you think that the market's reflexivity, response or reaction to events like these might change the way that we start structuring trades from here on out? Like to the point of getting trapped in this type of environment, people only like getting burned by the oven one time. So what changes about the way we manage capital after this point? Everybody's we've already observed a big flight to safety. The bond market went crazy from this. I think people are moving to more positions of safety and will slowly dip their toes back into the market over time, which leads me to believe that maybe volatility won't be as aggressive because it takes a long time to convince participants that everything's fine. You're not going to get burned again. And that takes, 2-3 years before people get trapped in this type of scenario again. As we saw with the VIX chart, just looking at the VIX historically, there are these long periods of time where it feels like market participants feel safer and safer and safer to add leverage, to tighten their stops, to maybe put on trades that are extremely risky, and they're doing it because they believe that the market isn't biting them, and then out of nowhere it bites them.
So what I would imagine happens is there's this trend that's happening now, you've probably seen as well, where in order to express a long or short position, instead of being long the stock or short the stock, more and more people are owning the options on that. They're owning the calls, or owning the puts. And so as people are not sure what's going to happen in the future, so for example, if you're not sure what's going to happen with the election, you might decide, well, instead of I want to be exposed to the upside potential of the market, but I want my downside to be capped. Well, then what you can do is to buy the options, and then you can have options on different time frames, and still be exposed to the upside potential, plus your upside to the convexity. And so that's how I would feel if I'm expecting liquidity to be pumped into the market because it's an election year.
Mm-hmm.
Well, why just be net long the stock? I might as well maybe have some stock position, but have 20% of what I would actually put in long dated calls, because then I could just be writing that into whatever they're going to decide to do with the pump of the market, and I'm only. And then my downside is limited. But also here, what seems to be happening, especially for retail traders, if you're to take Reddit and Twitter as an indication, is that the zero dated options, the short dated options, are so cheap that it's almost silly not to own them, because for a small amount you can 10x 100x your money if you do it in these periods of weaknesses. And then these periods of weaknesses are becoming more and more predictable. We know there are periods of weaknesses, liquidity weaknesses, I mean, where volatility isn't well supplied, and there's a downturn or upturn in liquidity. You have these periods where every quarter, it seems, every quarter there's just this window, this 2-week window where vol isn't very well supplied because it's being rolled over. It's, quarter end is closing out along with month end, and if you're going to take a bet at all, it's during these 2 weeks you want to be doing it. Then if you wait till volatility has been low for a little while, then if volatility has been low for 6 months, well, give it a shot. Give it a shot on the next quarter of expiration, because chances are you might make 100 extra money on that. And so I would expect more and more people to participate in these things, especially as the returns for these days start propagated around. People go, wait, you made how much in one day off of how much did you put down? What am I buying $100,000 worth of Tesla hoping that it goes? Why am I doing that? I might as well buy the options instead.
Okay, I see your point, and I think it's definitely a market that I haven't done a ton of research in to understand its correlation to the rest of the market. I understand the the mechanical aspect of why it impacts the equities market and even the futures market directly as we close out these contracts each day. And I think we've also observed that zero DTE contracts are becoming increasingly popular by the retail crowd, and as a result, that activity, I don't expect that activity to slow. So I hear your point. Like that desire to constantly be in these contracts and be buying lottery tickets every day is sort of how I would look at it. Is a contributor to the ongoing spikes in volatility that we won't see coming.